Hi, my name is Christopher Terry, CEO of iMarkets Live, and I want to give you a couple of tips on how I use the harmonic scanner and how to best find trade entries and use it. Now, we also have the web scanner. The web scan is amazing. You can click on the scans where it gives you the particular patterns, different time frames, and that's great. If you're on the go, it's a great tool to use. But personally, if you have a desktop computer, I suggest set up the harmonic scanner for your desktop. It's absolutely amazing. I love the structure and how everything's set up. So let me just go through it real quick. And this is the original scanner. This is a desktop version. Right here you have the available patterns. Right on the chart, we clicked right here is the USD Gives you all the patterns and when they're setting up. And it gives you the age of when it hits. Then we also have the pattern. It's a shark, so it gives you to both places. Then you have the X, A, B, A, B, C, B, C, D. And what that is, let me just see if I can draw this out in a color that you can see it in. Let me just make this a little bit thicker. Here we go. So A, B, C. So here we go. X, A, X, A, B. So here's your ratio of what you should expect for that particular pattern. Then you have ABC, A, B, C, and then it gives you all the different ratios. And what you're looking at is you want the market ratios to all line up and give you a trade opportunity. So we're going to continue. What's great is it gives you the entry zones. Okay, in this particular pattern, you got a minimum and maximum zone. And then you have your stop, which is your risk point, your target, take profits, right? Down here. And then you have your balance. Now, this is a demo account. I like using FXCM for my demo. For the scanner, it has clean data. Doesn't mean that I like to use them as a broker for the fact the leverage is kind of low. So you got your free margin, and then looking at your risk points, you could determine the risk on your account from that. So really nice and clean. What I also do is I like to use, and let me just fix my color again. I like to use Bollinger Bands. So here's your, what they call the mean, MEAN, your moving average. And then you have your standard deviations. Okay, these are standard deviations away from the mean. What I like to look at is when the market is pushing into these standard deviations away from the mean, setting up a trade. Let's take a look at what the indicators list is. So right here, Bollinger Bands, edit. You can see we have a 50 Bollinger Band. A 50 is your Bollinger Band, and then you got 2, 2.5, 3, 3.5, and 4 standard deviations away from the mean. So if I was to go here, actually right here, let me see if it shows it right there. Okay, 4 standard deviations. So you set it up that way, and I have videos on the site on how to do that. So a couple of things we can look at. That's the USD CHF. We also have the EUR CAD that's also been setting up. A couple of things I like. I like when you got the entry point and you got the Bollinger Bands tying in together. I really love that. I love seeing the market go away from the mean, meaning, that's funny, meaning that here's your moving average, here's your entry, and also right in that area is you have your Bollinger Bands, your standard deviations, because the goal is basically to come back eventually to come back to what they call the mean or the moving average. So that is the goal. When you stretch away from the Bollinger Band, you want it to come back. If you look at the past history, where it goes up here and comes back to the moving average, comes up here, back to the moving average, back up here, back to the moving average, all the way up here, even here, back to moving average, here, back to moving average, down here, back to the moving average. You see the game, how that is played. Even here, back to the moving average, down here, expect it to go back to the moving average. So I'm teaching a little bit different than we have in our other videos. I'm showing you some techniques that can vastly improve your trading style. couple of things I like to look at also, and it's not on every trade, but I like to see this where you have your CD leg. You see that right there? This is your CD leg, but within that, you have your 0 to 1, 1 to 2, 2 to 3, 3 to 4, and 4 to 5. You don't know how deep this leg is going to come. You never know how deep that leg is going to come. That's why you have a stop loss. What I like to do is a couple of things. Let's just say it stops here and turns up. It turns up, I like to look at that first pullback because it technically has hit the key entry point. And since it's done that and held as support and turns up, I like to buy that first retracement and put the stop below the last low, wherever that last low is. The other thing I like to do is, should this market drive down, I like to see a bounce, a pullback. Now, not buying this, but wait for this price right here. So when the market turns up and breaks through this prior little high here, that gives us that U-turn, what we had coined a U-turn many years ago, and putting your stop underneath the low. So where the market is driving down past the entry area, you want to wait for the market to stop going down. Just because the market's here, you don't need to buy it right away. You're talking these hour, 4-hour charts. Take your time, no rush. Let the market speak to you. Okay, I'd rather you hunt down one pattern a day, a week. I'd rather you hunt down one pattern and catch a nice move than try to trade everything and just jump in randomly. You want to take your time. So where the market goes past the entry towards the risk point, that means it's weaker. And you want to wait for that turning point. You want to wait for that market to dip and then turn back up and take out that high, with the understanding that this market can eventually come back up. The other thing is, as I said, it can hit here, turn up, and that's telling you a very, very good support at the entry, which is a standard entry. That means all our Fibonacci ratios all lined up here, and now the market's turned up. You take the pullback, you're buying it, stop underneath the low, and looking for a play higher, essentially. So real important. Number one, I like using the higher time frame charts, hour, 4-hour, daily charts. I also like using my Bollinger Bands. Reverse the video, go back to it, and of how I set them up. Or watch the other videos on the site, and you'll see how I do that. And then also the two different ways I like to trade the market. A, from the entry point, like that, buy it. Or B, come down, bounce, come down, hold, and turn. Because what if the market fails? You don't want to have to lose money. You always want to let the market stop going down. Let's take a look at the USD-CHF. USD-CHF up here. Okay, 4-hour chart. Let's take a look at an hourly chart. So, no rush, no rush. What if this market has hit the top of this entry here and now starts to kick lower? Nothing wrong with that. You don't have to be the guy that gets it way up here. You're not on Facebook. This is your money. This is your career. Let the market come down, give a bounce. Okay? You short, you sell them, looking for a big move lower here. As you can see, the market's pushed up into its standard deviations on both the hour and 4-hour charts. And what if? What if this market keeps driving up? Keeps driving up. You don't want to get caught. Market keeps driving up, goes like that. If it turns down, you sell them here and look for a move down. You don't want to be the guy that gets caught. And if it happens this way and you don't miss a trade or it comes down, big deal. Not a big deal. You're coming up for another test up here, and you're always looking for opportunity. Just take your time and enter. Never a rush. When the markets turn, you will know it. They will give you a shot to get in. And even down here, see something like this, how the market stretched out, pulled back, and then rallied. Here, turned, bounced, and then fell. You're always looking for those type of moves. All right, so just keep an eye on that. I'm just giving some cool techniques that I like to use when looking at the market. All right, so let's just take a trade right here. Let's just take this trade right here. Okay, market went down, hit the point, and turned up. You missed it. Okay, Those of you that want to be super aggressive, that's fine. I like to wait for the pattern to give me an entry and then take it. I don't need to go into every pattern. Not every one of them is going to be nice and clean, but that's just the nature of the beast. That's the way the market works. You see, you want to make sure the prices have stopped going down prior to doing anything. See this? Okay, not good. Okay, here's another example. This is when patterns attack. This is exactly what I'm talking about. You want the market to come down, you want it to go up, you want it to bounce and then take off, or you want it to come down here, here, like that. This is what you're trying to prevent, getting stuck in this. If you can eliminate those losses or those failure patterns, you will raise your game level so much higher. I also, like I said, I like to look at these markets when they're pushing into the Bollinger Bands. As you can see, it's a pretty powerful concept. Okay, pretty powerful concept when they push into the Bollinger Bands. Now, let's take a pattern like this. That's another thing. You see where the entry point is at the mean? I don't like that. I like to see them when they're when they're expanding away, like you see here. Okay, let's just take a look. You see that? I like it when they're expanding away, away from the mean into the Bollinger Bands, into the standard deviations. All right, I call this the extrapolator. Okay, that's my nickname for it. I've been using that for many, many, many years. And it's a tip that I wanted to share with you. My name is Christopher Terry. I hope you enjoyed the video. I hope you got some good gold nuggets out of it. And again, if you're using the desktop, I suggest use this desktop version. Otherwise, if you're going to use the web scanner, it's fine also, just a little bit extra work. Have yourself a great, great trade.